Never mind, Chad. Well, thank you. My internal view, I'm a partner here at Orrick. We, as Chad mentioned, we're a law firm that focuses on this, on working with great early stage technology companies. The panel here is tremendous. Obviously, we have unbelievable experience represented on the founder side and on the investor side. So this is an amazing opportunity for all of us to learn a lot about mistakes and best practices that we might want to think about as we start and move our companies forward. Obviously, this is a very large, broad topic, and I think we're going to do our best to narrow this and organize it in a way that's helpful to you. But we definitely want your help in doing that. So we'll make this interactive, and at the appropriate times, I'll ask for questions, and if you have questions, please do so. The other thing we should cover quickly is we want to make sure for the benefit of our panelists that we understand who you are. So my guess is that we have a lot of founders or other members of startup companies here today. So maybe if you could indicate by raising your hand, is that who we have here? So yeah, pretty much the entire audience. Investors? Investors, okay, great. Others, great. Okay, so I think it's very founder focused, very early stage focused. Terrific. So let's get started by just introducing the panel. So maybe if each of us could say just a quick word about who we are, and we'll go from there. So Gentry, that'd be great.
Hi. Hello. Hi, I'm Gentry Underwood. Previously the co-founder of Orchestra, which made an app called Mailbox. We were acquired by Dropbox about 6 months ago, so now I'm an indentured servant.
I'm Ken Goldman. I'm a partner with First Round Capital in San Francisco.
I'm Aileen Lee. Hi, I'm Aileen Lee. I have been with Platter Perkins for a long time, and then last year I started a small seed-focused fund called Cowboy VC.
I'm Jacobs, CEO and co-founder of Whistle, a company focused on pet health, and we make hardware. So any of you hardware entrepreneurs, happy to talk about that.
And Rahim Fazal was the CEO and co-founder of Involver, which was acquired by Oracle, and I just, as of yesterday, hit my 1-year cliff. I thought that would be worthy to note. I've been celebrating the last 24 hours.
Are you going to work today?
Well, I am here.
Terrific, thank you. So I think we all start by thinking to ourselves, I'm sitting in Phil's and I've got the idea for the next huge thing. It's my idea. I'm at some other big co right now. It's completely mine. I haven't talked to anybody about it. I could bring in some others. I could maybe start to build out my team. Or I went to a lot of these great Orrick events. I met some of the great investors. Maybe I could just go and start talking to them right away. What should I do? So I guess the first question for the panel here is, as a first step as an entrepreneur, what's the next step for me once I've figured out what it is we're going to be doing, building? It's revolutionary, it's going to be IP protected, it's going to be novel, it's going to be all those things that all of you are going to ask me. So what's the next step? Jeffrey?
I think more important than an idea really is a team that you work extremely well with that complements the things that you bring to the table. So I think for me the most important thing was finding in particular a co-founder that I wanted to be in a very deep and arduous relationship with. In many ways it's a more trying relationship than even a marriage, getting one of these things off the ground and trying to take flight, and having a partnership that both complements your skill set, but also somebody that you trust deeply and can work closely with. I think that's square one, I would say.
And actually, I think that really touches on one of the big topics, which is kind of who is that co-founder? How? I mean, obviously, sometimes it happens very organically, naturally. It's an idea that I jointly developed with others that I know, and so forth. There's people that I partnered with in the past, but if that's not necessarily the case, what efforts do I expend and how do I go about that to find the right people and to build that team? Are there others that maybe have some thoughts on that?
Yeah, to Gentry's point, that's exactly what I was going to say. More important than just you and your idea is definitely the team. For us personally at Whistle, I have 2 co-founders. I trust them both enormously. It's never easy. You're going to go through ups and downs together, and I think having that base of that relationship is probably the most important thing you'll do. Definitely don't be greedy in any way when you think about building that initial team. find people you really trust and want to work with in the long haul. One thing that was really interesting to us, it wasn't necessarily about the cookie cutter skill set of finding the exact hardware engineer or firmware engineer who would be my co-founders, people who at their core personality traits were good fits for me, and then ultimately my second co-founder and third co-founder as we started working together. I think that's often overlooked when it comes to those traits versus just a resume that you want to match together. It doesn't work.
Yeah, I completely agree. I think that there's so many places where you can, go through the process and exercise of finding a co-founder. I think that's sort of less of an issue than it is really finding the right co-founder. And so when it comes to values or when it comes to things like the chemistry and the complementariness that you get between yourself and someone that you need to work with. Like one of the things that I've been thinking a lot about is just being how self-aware I was 5 or 6 years ago when I started Involver, and how self-aware I am today. And I feel there's such a huge gap. I think when looking for the right co-founder, you have to start by looking at yourself and really understanding what your sort of gaps are, and being very real and honest with yourself about those things, and then being clear that you're only going to work on what you're most uniquely qualified to do, and for the things that you're not most uniquely qualified to do, you're going to find someone to really match you there.
I want to sort of, I think, echo what Gentry said. When he was talking about sort of finding a founder being like a marriage, I was actually sort of thinking back to a book I read recently, which was Daniel Kahneman, who's a terrific sort of behavioral psychologist. He wrote a book called Thinking Fast, Thinking Slow, and he actually lays out a well-known formula among behavioral psychologists for a successful marriage. And it's something along the lines of you have sex with your partner more often than you have quarrels. And amongst founders, there's usually much more opportunity for quarrels than there is for other things. Not that it doesn't happen, but so I think sort of like picking the right team is really important. The other thing that I would say is it's not enough to just pick the right people. Since we're talking about mistakes, I would say is a mistake that I've often seen is founders will get together, they'll decide they want to start a company, and nobody knows who the CEO is. Nobody knows where one founder's responsibilities start and another ends, and that just winds up leading to to the amount of passive aggressivism and effectively failed marriages and tortured conversations, where if expectations had just been laid out very clearly and concisely from the start, I think things would go a lot better. So take the time. It's a difficult conversation, but take the time to say, I'm CEO, you're CTO, or just divide very much to where the responsibilities are, and understand that even if you're CEO, if you don't have a great CTO, you're not going to get anywhere. So it's not a question of who's more important than the other, it's just who has what responsibilities.
I think the thing I'd add to it is, I think getting your team together, everything these guys have said, I would totally agree with it. Way before you talk to investors, you need to figure a lot of this stuff out. But when you do come to investors, I think in general, investors like to see teams of co-founders who've worked together before or gone to college together before. It's not a blind date or arranged marriage. It's people who actually have experience in the trenches together. But we're also trying to understand how you think as a founder, as a team of founders, and what kind of self-awareness you have. So sometimes if we'll meet a team and they don't seem to fit together, or one guy or girl doesn't seem like he or she brings specific skills to the table, and you ask whoever the CEO is, like, so talk to us about how you thought about this co-founder and what they add. And if you're not coming across as, yes, I've thought about these issues or potential shortcomings that this person had, but this is why I think this person is a perfect founder, and that there really is thoughtfulness to how the team comes together. It's an early reflection on your judgment and your thoughtfulness about how much time and kind of thought and strategy you have put behind the initial founding team. And if it doesn't fit, like if there's one kind of nail that sticks way out, and it actually can be a poor reflection in your first meeting with your potential investors, that you may be rushing into this, and that you may not have the right judgment about people, because the first 3 or 4 people you bring to the table are going to have a huge impact on the next 3 or 4. And if the first half isn't good, the second half is going to be worse.
I was going to say, you hit the nail on the head. I think how many meetings we had when we were raising money early on where an investor would say something to us and push back on us, and we would say, oh no, that's not a problem, we have that covered. Oh yeah, that's not a problem, not a problem, not a problem, not a problem, not a problem. And it was so obvious in retrospect that there was a gap there, or maybe that product market match wasn't quite ready, or whatever it might be. But I felt like we had all this pressure to have all of the questions answered. And I think over time that kind of kind of self-fulfilling or self-perpetuating in the sense where we actually then believed that we had all the questions answered. And that's when you start to go down the wrong path.
Great thoughts. I think and I think it is the typical situation to have a team in hand before we approach the investors. One other situation though that I often see is actually the situation where we have a single founder who believes they have a great innovation and may not have those contacts. And how important is it for that person to try to build that team on his or her own before going to the investor, or is it an alternative to have one of you basically help them do that? Is that a situation that you'll be comfortable with?
I mean, I think the CEO's two primary jobs are to sort of get money in the bank, to make sure there's always money in the bank, and recruit a great team. So if you're starting out by saying, I can't find a co-founder, it's not a great sign, that you're taking care of responsibility, number two. I also sort of think that, when you go back to sort of starting the company and why you want to do it, it's really important to remember starting a company isn't a career step. I mean, it is a painful, arduous, at times exhilarating, but most of these things end in failure. And what I've seen is a lot of people who are sort of reach a certain level in a large company and say, okay, the next logical career step for me is, I don't want to be a VP at Google or wherever, so the next logical career step for me is to go start something. And those are oftentimes the people you see who are don't have a co-founder, and that's because they haven't found a vision that they can sell or that people want to buy.
Great, okay. Any other thoughts? Any questions on the topic of team building formation? Yes?
Real quick, so you addressed a single founder, but if you have 5 co-founders, that's got to offer some other type of dynamic versus more often what I've seen is 2 people who co-found something. But what's the experience with 5 people?
Yeah, so we have 3 co-founders.
Oh, sorry.
Yeah, so I can clarify that. I don't know if there's a magic number. I've seen teams that have 4 or 5 co-founders. In many ways, we think of our employees 1 and 2 as founding engineers as well. I think ultimately, I just extend it beyond the co-founding question into the broader team and just emphasize again, at least for me, the most important thing is building a team that doesn't end with co-founders. Particularly in hardware. After we raised capital, actually, we hired some of the more experienced people on our team, decades of experience shipping consumer electronics. It was really important for us to bring the people on and make them not feel, but truly be, founding members of the team and empower them to drive the organization forward. And I think, it's ultimately our job to, as Ken said, push the broader vision forward, but really have a team of leads that can push the entire company forward and feel able to do that. And I don't see that as a conflict.
Yeah, I have a slightly different perspective. My perspective, and this is sort of the general rule of thumb, there will always be exceptions, but using the marriage analogy again, I find that business partnerships work best when there are 2 people involved and not multiple partners. It just kind of gets a little bit tricky, I find, when there are multiple partners, and again, so as in marriages too.
Yeah, one more here. Yes. Go ahead.
What's the best practice on handling equity splits when it's 2, 3, or 4 co-founders?
I can say in ours, so it's just a marriage of 2. We split everything down the middle, and it just meant that we didn't ever have to worry about any sense of hierarchy. It just simply went away, and that was a wonderful thing. Other people don't do it that way, and they probably have other ways of managing it. It was really nice to know that we were very much in this together, and that there was literally a sort of an even match in terms of upside or downside and risk. When we kicked in our own money at various times, we always made sure that we matched to the dollar, just because it kept us on that place of feeling like we're on the same page.
So I think I don't think there's a right or wrong answer there, but I do think it can be tricky oftentimes. Let's say if you have 3 co-founders and you split it 3 ways, but whoever the CEO is, at the end of the day, will usually, almost all the time, be bearing the weight of the world on his or her shoulders. And then it can create a little bit of a messed up dynamic because 1 or 2 of the other founders who may not be bearing as much weight as the others, it can feel like they have a target on their back. Because the CEO can't sleep at night, we missed a quarter, the board's coming down hard on him or her, something fell through, the CEO feels like like at the end of the day, the buck does stop with the CEO. And if they all have equal equity stakes, it can create messed up dynamics sometimes with founders. But again, I don't think that means that you should, I don't think there is a proportional amount that should always go to the CEO, but I do think it's something you should be aware of when you think about, because in the beginning it's all happy, it's like, oh, let's make everything even. You're not really thinking about how you're going to feel 3 or 4 years into the journey.
Okay, just one more and then we'll move on. Yes?
Hi. Your comment about if you've gone to school together or you're coming from another company, you've had to start a little with this team, that eliminates a lot of people. So, is that common among investors, or is that specific to Cowboy?
Right.
That you're only
Sure.
looking at those people, those
No, I'm not
startups?
saying I think if you do look at a lot of successful teams, oftentimes maybe they worked at Google together, or HP together, or Adobe together. So doesn't have to have been at a startup, but I do think that, like Ken said, it's such a personal and intimate relationship in a lot of ways. Having some prior context in some way. Maybe you went to college together and you just kept in touch for the past 20 years. And kind of been advising and coaching each other through your different job changes, but there's some prior context. I think that is, if you made a list of the top 10 or 20 companies that you admire the most, my guess is the majority of them would have founders who have prior context together.
Yeah, I think sort of with every startup, it's really a journey through a bunch of unknown unknowns. And one of the things that you can know at the start is your relationship and the character of the person that you're building the company with. And what I take Aileen was saying is know their talents, know their faults, know your relationship dynamic, and don't try to figure that out on the fly. It could work, but it's so difficult. So just having that prior context helps immensely.
Yeah.
Okay. Go ahead,
I was
yes.
just going to say to Aileen's point, I think it's not just looking at it from the perspective of what are the investors' concerns. I think that you have a mutual alignment here, and so those should also be our concerns as founders as well. And so ultimately, the reason that question is asked is because of the complexity and the risk from that complexity of launching one of these startups. So how do you reduce that risk? And one of the indicators might be that you've worked with this person before, and because you worked with this person before, maybe you have trust and you've kind of worked out some of the kinks and so on. So I almost think, again, you kind of turn that question inward and ask yourself, like, what is it about this person that I've chosen to work with? Or what are the things that even before that, what are the things that I'm looking for from someone I might work with that would reduce the risk in me launching my venture?
I agree, and just one last point. Internally, for us, one of my co-founders and I used to work together at Bain, and an element of that's an advantage, not just in terms of our relationship. I've seen him in stressful environments before, is it actually gave us a bit of a jump start on our culture. And I think you see a lot of companies come from places like Google as well, where if you can take a kernel of a company culture you really respect and then have that be part of your founding story and give you some core principles, it aligns you and your founding team as well.
Okay, so we've got the team in place now and I need to raise capital. Obviously this is the big first inflection point for us as a company. I think I made the decision that the time's right, so I'd love to hear from the panel about what's the best way to approach the investors, including the persons represented here, as well as what are best practices or other mistakes that maybe founders can make in this initial part of the process. Any initial thoughts?
Well, again, going back to the point of thoughtfulness, I think that the question of all the tactical stuff, like how do you actually go out and find investors and pitch them and put a deck together and get the second meeting, I think all of that it's somewhat more straightforward than the harder part, which is the upfront part, which is, that level of thought that you need to have in what you're actually asking for and why you're asking for it. And so, oftentimes, last year or so, I've seen a lot of pitch decks and help people raise their funds, and I'll get to, oftentimes it'll be the last slide I look at, which is where they have somewhat of an operating plan or some numbers that sort of help describe the way they're thinking about their business. And when I start to kind of poke into those places, I realize that there maybe hasn't been as much thought into the mechanics of how this business is going to operate, how it's going to grow, what the risks are, what the milestones might be, so on and so forth. And I think fundamentally it's that thinking about how you're going to shape your business. And specifically, I really like kind of putting numbers to it to really help codify it, which I think is far more important than pitching somebody.
Yeah, I think you hit a lot of key points. Far more important than the tactical. And there are tactical things. Don't cold email any investor in the valley. You're all in this room. There's secondary connection from someone in this room to probably any investor you want to get to, and make sure you leverage your secondary connections and be creative to reach out to these people, unless you two will disagree. But I certainly have never seen real great outputs from that kind of thing, cold emailing and cold calling. But far more importantly, I agree, is know your business. And don't just know the upside of your business. If you're an entrepreneur, of course, you should be blindly passionate about what you're building. You should, if not have a slide, you should at least know in the back of your head all of the reasons someone should not invest in your business. If you don't tell the VC directly, they know all the reasons. I build consumer electronics. I can tell you all
You're in
about
the hot space now.
Yeah, well, not now. So the last 6 months, it's a great business to be in. But for the decade before that, it was a low gross margin business with a concentrated channel, huge reliability issues, a hit-driven business. But and we build it for pets. I can tell you all of these reasons why you shouldn't invest in our business. But if you know those reasons, you can at least address them. They are inherently risks. What these people do to my left is they make risk-adjusted bets. There's going to be risk in your investment. So make sure you focus not only on the positives of your business, but the drawbacks as well.
So the thing I'd add to that is, I think in today's fundraising environment, traction is really important. And so it's not, raising money is not about putting together a good deck and a good financial model and then going to meet with people with money and getting money, right? It's really about, like, we're backing you for a long period of time. There are a lot of ups and downs, and so a lot of what we look for is the quality of the team and the chemistry of the team, but also your hustle, right? Like, and that you've done a lot of homework to convince yourself that this is a good idea. So you've made a prototype, you've created like fake landing pages and tested how much things are going to cost. You've run surveys, you've done mock-ups, you've interviewed customers. Like you've put yourself through the paces, and your team has basically been willing to make some sacrifices to really figure out if this is worth doing. And that kind of shows both you go through some trial by fire where you have some tough times and you're like, is this gonna work? Or like maybe this assumption was wrong, and you've kind of figured some stuff out, and maybe you've even got some users using the product, a very rough one. But coming to investors with some experience under your belt is a really awesome thing to do, I think.
I think on the how do you connect with investors, the same way you want to see sort of a strong relationship among sort of the founding team, and as an investor, sort of I view sort of the founders that I meet with is it's a relationship that I'm going to spend the next 7 to 10 years investing in, and so I try to find shortcuts to understand who those people are, what makes them tick, and an introduction from someone I know and trust is sort of the quickest path to that. It's not that sort of that introduction sort of necessarily validates someone. Is that there's someone who I can pick up the phone call and say, well, help me understand how this person thinks, and we have a sort of base commonality there. And then I have some thoughts on pitching, but I don't know if we're going to get to that.
No, please, yeah, absolutely.
So big, since we're talking about mistakes, one of the biggest mistakes I see is go into a conference room, sit down with the founder says, so, do you want to see a deck, or should we just have a conversation? And to me, this is, it's such a false choice between the two. Nobody in the history, at least of seed stage startups, has ever wanted to have a presentation where someone stands up and clicks through PowerPoint slide after PowerPoint slide after PowerPoint slide. Everyone sort of always wants to have a conversation, but no investor that you meet with, no person that you speak with will ever understand your business and your product as well as you do. So what you want to do is go in and be armed with some sort of visual aid, whether, it may be a deck that helps explain the story behind the market, it may be a couple of wireframes that help explain the product, but make sure that there's something tangible to center the conversation around, and do everything you can to steer that conversation as a founder in the way that you want the conversation to be steered.
Yeah, I think if you think about it, both parties in that setting are selling. And in most cases, the first meeting, you really are doing a lot of selling. So the responsibility lies on you as a founder CEO. What is the best way, and what are the best tools, or what have you, to sell your company? I mean, that question is up to us to figure out how to do it best.
Yeah, just leading into Ken's point about the relationship, I think one of the big takeaways for us was that one of the things about raising money is you're doing two things at the same time. You're trying to add capital to your repertoire of capacities as a business, but you're also bringing other people in as team members in what's probably a very small, nascent, and forming culture. And these people are going to shape how you think about the space you're going after. They're going to shape how you carry yourself as a business, how you handle things like board meetings if you're doing an equity round. And those are big deals. So to think about the people that you're talking to, not only from the lens of what kind of capital they could bring, but really what experience they're bringing, how you feel when you work with them. I had investors where I would leave every time second guessing everything I had thought going in, and not necessarily in a good way, more in like a confidence destroying way, and that felt like a very dangerous sign. Other ones where I was asking questions but in an emboldened way, where I felt like, okay, there's some good ideas, but I still feel like we can go tackle this space. And finding those, paying attention to those pieces alongside the more nuts and bolts of the actual money is, I think, a pretty important part.
Great. Well, let's say I've got the team, and I've got the traction, and the connections, and so I've got a fair number of people telling me, all right, you should talk to various investors. As a founder who may be in some demand in this situation, what are the thoughts that I should be having about how to choose the kind of investor? What are the things that I should be asking of the investors? And maybe related to that, what are the types of investments I should entertain? Is it preferred stock? Is it convertible notes? Is it how do I want to start thinking about these macro level issues that are going to affect me significantly? Any immediate thoughts from the founders?
The tactics of your round I'll put to the side. Really depends on how much you're trying to raise and win capitalization of your company. I think Gentry's point, though, is spot on for me. There's almost a gut feel for some of these conversations, the same way with a team, where you'll leave with an investor who might be high profile or whatever it is, or maybe you just really need the capital and you feel like you can take this money. But if you leave and don't feel safe, this is a very long-term relationship. Just like a marriage in between founders, board relationships are very complex as well.
And everyone, just like marriage, everyone's behavior just gets worse.
I mean, Ken nailed it. If you leave a first meeting with an investor where theoretically you're both pitching each other and telling each other you feel weird about it, I mean, it's a sign you should at least read into and think about. For us, very tactically, we only have one outside board member. His name's Jason Krikora, and I feel very lucky to work with him. And that's not just personality-wise, but he's very engaged in the product, and he's built hardware before. So for our business specifically, he adds a lot of value because he understands the cycles of hardware, doing things like QA on firmware, understanding all of those nuances. I mean, the other investors just wouldn't get that as much or dig in as deeply, and that's been really important to us.
Yeah, it's such great points. When Kent said it's a 7 to 10 year type of relationship that he's thinking about, I think it's so true. And one of the things I don't think founders do enough, to the points that you're hearing here, is asking the right questions. So again, you're selling, as I said, in the first meeting, or maybe the balance of it, but the other side has to sell to you as well, and it's important for you to make sure you're asking the right questions. And one of the things I think is most important is, and I think it's very much a part of what we just talked about, so that feeling of comfort, but I think that comes for me from empathy and really getting a strong sense that the person across the table can empathize with you. They have strong empathy, there's so many different things that could possibly go wrong or right with the company. It's impossible to ask and kind of solve for every situation. But if you know that if you get into a tough spot, and let's say you need a bridge because you didn't meet your numbers and it's taking a little longer to close your next round or whatever it might be, to the extent that the person across the table can really empathize with you, and many other things as well around sort of incentive alignment, the structure of the fund and so on. But I think empathy is one of the things we miss so many times, and if we can really feel comfortable about it, I think that's such a strong predictor of success in that relationship.
Do lots of reference checks. One thing about sort of investors is it's easy to know who their winners were, who their losers were, because it's all relatively public. Call founders at both, find out sort of what, how investors reacted after, things didn't go right. What happened sort of during the tough board meetings when you didn't hit your numbers, or what happened between board meetings when it was clear you weren't going to hit your numbers. What sort of advice did you get when did they get when there were sort of founder issues to be discussed? And I think the key thing that you really want to try to understand is whether or not any investor feels like someone that you can call and sort of very transparently feel like you're reaching out to them to get good advice, and you don't have this fear of consequences or fear that you have to manage them. So you want to find sort of references that will get you to there. And if you don't see them, just be nervous. Be very, very nervous.
Great advice. Any other thoughts from the panel on this? Oh yeah, go ahead.
Just in terms of structure, just because you're.
Please.
As an investor, I prefer equity, and I can tell you sort of all the reasons why plain vanilla seed equity round is beneficial and great and can be done as quickly as convertible notes. But what I'd say sort of generally is the structure that you want to have is a structure that gets the people you want around the table.
Oh yeah.
Oh, I was just going to talk about references, but you can come and talk to me after that, after the panel, and I'll dig into it more.
Let's flip the situation just a little bit on fundraising. And there's been a lot of discussion recently around crowdfunding. The SEC is talking about making things easier so that we can potentially engage in what we call general solicitation. Just quickly, are there any strong thoughts from the panel around companies that engage in this and then perhaps go to the more traditional Sand Hill Road types? Is this a mistake in some sense? Any strong views?
So I don't think it's a mistake. And I think, especially, I'm a fan of Kickstarter, especially for physical products, because I think it's a great way to get validation and raise money, and especially in what can be a tough hardware or physical products fundraising environment. But I guess, I'm a little biased, but I feel like there's no substitute for having really good, experienced, thoughtful people around the table and anchor investors who actually really are invested in you and are there with you. I just have seen over the past years kind of party rounds where you raise a couple $1 million, but there's really no lead and you don't really have a board. That we're seeing, Kent and I probably both see a lot of companies who come out the other side and don't make the milestones that they were going to make. They're not ready for a Series A and they need more money, but they also maybe have gotten some bad habits because they haven't really had any accountability or set milestones or had board meetings for a year or two. And so, I feel like having, even if it's not a real board, kind of a fake board, and setting up a rhythm of board meetings every 2 months where you say what you're going to do and then you kind of talk about what went wrong, what you learned, what you need to do next. That's training, because these great companies take a decade to build. And so your seed investors are helping you get ready for your Series A, and your Series A investors are helping you get ready for your Series B, and there's just skill sets and communication styles that you need to develop as you're helping to scale your company. And so I feel like if you start out with, $20,000, $100,000 checks, you're often not setting yourself up for that kind of progression.
I mean, another scenario is everything's going perfectly right. It's just taking a little bit longer.
Right.
And so what you thought was going to take 18 months is clear it's going to take something closer to 24 months. And usually sort of having a couple of those, I don't know if I'd necessarily say deep pocket, but having some more sort of institutional sort of lead type investors, they can help you sort of either provide capital themselves, or they can sort of, they're great at rallying sort of other deep pockets to come to the table or see the position your business is in a different way. I mean, having said this, we're investors in Funders Club, so I don't think crowdfunding is, it's here to stay. And I think with the SEC changes, it's only going to get deeper. So if nothing else, I guess for us, our investment in Funders Club is sort of a hedge against our own success.
Understood. Yes.
Yeah, just riffing off this, I think the way that you create that, over time, that trust and then that readiness for your investors to kind of help pitch in when things don't go exactly the way you want them to is by making sure, as you were saying, that you have this regular communication with them. So in our case, I didn't want to really have a board, and we had a number of different investors that put money in, and I was quite happy with just running the company the way we were, and it was working very, very well. And then as soon as things went wrong, 3 or 4 years into it, and at that time we hit some good level of scale, 50 employees or so. We needed to get our first institutional round. I realized that sort of we needed a bridge, and when I went back to my investors, because I hadn't really communicated with them in 3 years, they had no idea what had happened quarter to quarter to quarter. Right? All of a sudden I had to educate them from the beginning, and it was like a cold start. It was so difficult for me. I realized that had I just been more mindful about my investors' expectations in me and in the company, we could have solved this problem. And so we created a board, and we did more regular updates, and we had much more interactivity. And although it was something I was so against at the beginning, I realized the benefits of doing that. I mean, there's so many benefits of having the investors on your side. I mean, that's really why you started, why we all got into a partnership to begin with.
And that's a great point. I mean, I think finding investors in the best sense is also sort of finding people who can help sort of flesh out your team. And whenever there's certain companies that sort of whenever I see it, I always think of Aileen, and I actually think how can we get Cowboy in around the company, because Aileen understands commerce, so among other things, but so incredibly well. And so it's not just when chips are down, it's when there are investors who should be able to sort of, if they're engaging around your business, really help accelerate it, make some meaningful introductions, help recruiting, and that's important to think about as well. Trying to be positive, it's still in the morning. Hopefully nothing's gone wrong yet.
Let me just take one. So one flipping back again to founders who have a lot of leverage. One other topic that often comes up to us as counsel, and then is passed on to you as the investor, is requesting and putting in place significant provisions that are very founder-friendly. And those include the composition of the board, giving the board control to the founders. That includes what we call FF preferred stock, or founders preferred stock, a method of getting founders liquidity in future equity financing rounds in the company. Now again, these are terms that typically don't happen in most rounds of financing. However, for companies that do have leverage, for the founders that do have leverage, they may decide to ask for those things. Any thoughts from the panel around these terms and whether to get these cleaned out before they get to you and so forth?
We didn't do a preferred stock. We had a couple of options to do different things like that. I think this ultimately gets back to Gentry's point, what Aileen and Ken, as everyone's saying. Don't optimize for things like that, in my opinion. Optimize for finding the right partner. Don't optimize for an extra $1 million or $2 million in your pre-money valuation. If there's someone that you really feel good about, it's going to be a decade-long relationship, hopefully, and you want to be there together. And so I wouldn't focus on those terms. But that's just me. I know there are other founders who disagree with that.
Yeah, I think when things go bad, and I hope they don't, but in many cases they do, all of that stuff will be taken away from you anyways. I don't think it really matters in the end. I tried to overstructure, and then when it came down to it, I mean, and we needed cash, all of that I had worked so painfully to structure for years and years, all went away, and in this, I would say in the sign of a pen, but in the submission of an echo sign, So I cannot overemphasize how important it is just to find the right people who are invested in you, who share the same vision, who are aligned with you, and work with them through these problems. Because in the end of the day, your investors want you to be as incented as possible to, to get the job done. I mean, that's the nice thing about these structures and nice thing about equity, that you guys are all on, all on the same side generally, right? And if you find the right investor, they will make sure that it is structured the right way for you.
Great. Any other thoughts? Okay. So on the topic of fundraising, any quick questions? Yes.
I just wanted to go back to the debt versus equity question, because I thought there might be some more perspectives on convertible debt versus equity.
Sure. So the question around, again, best practices around structuring debt versus equity. Any thoughts?
I mean, some founders prefer debt, right? Because it gives you more flexibility. So I think you guys might be trying to. I think I would say we prefer equity, but we do both. And
yeah, we're the same way. Sort of, we prefer equity. We'll do both. I think sort of probably about 18 months ago, people would raise convertible notes and they would look at sort of or at least capped convertible notes, and they viewed sort of the cap as in fact it was negotiated as if it was a price. So if you're going to negotiate it as if it's a price, you may as well just have a price round. What we've now seen is, as the market's cooled off a little bit, subsequent sort of follow-on rounds are oftentimes coming in sort of at or below caps, and so it's this sort of this rude awakening for everyone that actually a cap wasn't a price; it was a cap.
yeah, I think the thing I'd add to that is, like, sometimes debt can be a little bit of like mental kicking the can down the road, but then when you do your equity round and you've raised maybe like a seed round and a seed extension, so you have like $2 or $2.5 million of notes, and it gets converted in at the equity round at a discount, then all of a sudden you have a lot more dilution than you thought you were getting when you got the term sheet from your Series A investors, because they expected a certain kind of post-money ownership, and so so you kind of are. Just, if you are going to do debt, just make sure you are clear on how much dilution that really means when it gets converted.
Oh gosh, so true. I did 2 years of business school, and I still had no idea what warrant coverage actually meant when it came to doing our notes. I think I just I thought, oh well, that's no big deal. I guess it was something I just put aside for some reason. I just figured, well, if I do debt, it's better than equity. And in the end, you always, as an entrepreneur, you always think, of course, you're going to be more optimistic. So you'll think that when the debt does get converted, it's going to get converted at the highest possible amount. It's going to get converted at this cap. And there's so many times when that doesn't actually happen, and you end up getting screwed. In the end of the day, it would have been so much easier had you just done it up front, right, before you had to present your numbers, which eventually were 20% less than what you would offer at the beginning, and just get the deal, squared away from the start.
This may be obvious, but equity itself is basically just about aligning incentives. Whether you're talking about an investor, an employee, or a co-founder, it's about everybody sharing in the winning or losing of this thing that you're all creating together. The one play that's a little dangerous is going after a uncapped note, and some people are drawn to that because of the theoretical endless upside. But what you're really doing is you're misaligning incentives. You're basically setting up a situation where your investor is better off not helping as much, not really leaning in, not doing things to raise your valuation too early, because they're going to convert into more equity if basically when you go raise more money, they help you after. So anything that you can do that's going to mismatch you want to create a situation where everybody who in one way or another is touching your business is helping you push it in the same direction with all they've got, because that's what's going to get you over the hump and into a place where you can build something that's going to take off.
That's a great point. Yes.
Yeah, I have a question about the flexibility you're talking about with convertible debt. I mean, I took notes and I'm really happy I did, but I have a weird situation. I'm reincorporating out of Canada. I don't see much upside for an entrepreneur to invest in a note outside of my weird situation, because really all it is downside protection for the investors. They get the cap, which sets, I guess, the minimum amount of equity the investors should take, and then if it's worse than that, the investors don't get hurt. If you do a price round at a lower valuation than the cap, the investors actually end up with more of the company. So I don't understand why founders are so crazy about debt outside of weird international stuff.
Well, there's always the practical reason, which is it's a much quicker, traditionally it had been a much quicker, cheaper transaction. It's typically 1 or 2 documents.
Not anymore, right?
Yeah, no, still. I mean, the documentation for a note financing is very simple, and it's very set, and typically it doesn't include a lot of alternate rights that are introduced in a preferred stock equity financing, like a board seat or voting rights and other things like that get negotiated during a preferred stock round. So outside of all the other reasons we just talked about, there's just the practical reason that often companies need to raise $500K in 24 hours, and often the fastest way to do that is to do it as a note.
Yeah, from the entrepreneur's perspective, I think we have this sense that we'll have more negotiating leverage on the cap than we might if we priced it today, right? And I think that's the other intention I imagine from founders. I know that's why I did it, but I think in the end of the day, from the feedback you heard here, it sounds like there's a stronger preference, at least neutral, stronger preference for just pricing it right at the beginning.
Yes.
So Gentry, to your point about aligning incentives, if you take that to the extreme, everybody should just own common stock. So is that ever an option for institutional investors, or is, like, I mean, it seems like we're talking about debt and preferred, but we're missing the thing in the middle, which is common stock. So what's the trend on that right now?
Okay, so there's again a legal reason for preferred stock, which is it separates the rights of the preferred have different rights so that you can actually price and sell shares at a much higher price to investors. If you sold common stock to investors, then you'd be granting options at that same price to your employees, and they would be very unhappy about that. So there's always been this dichotomy between the 2 classes of stock for that reason. So that's, yeah, go ahead.
Over time, especially seed stock tends to look very much like common stock, and in fact, sort of in most exits or sort of in any sort of acqui-hire type situation, you know, Series C effectively looks much worse than common stock. It's just sort of it's the dynamics of these things. Every, you know, as we heard before, sort of whatever time you put into trying to sort of document or setting up your corporate structure just perfectly, it totally gets redone at the time of exit. It completely, and I'm saying this as someone who did corp dev for a long time. I mean, I used to sit around and, you know, try to find ways where I could funnel more money to founders and, you know, clean out the investors, because I wanted to keep the founders as incentive as possible sort of when I bought them, and that still goes on. So I wouldn't worry too much about structure. When you get to sort of Series E and you're raising from TPG, read your documents very closely until then.
Just one more, yes.
I have a question about board. What is the best time to create a board?
So actually, why don't we pause on the board, because we were going to get to that as a separate topic. So let's pause on that for a minute. So why don't we move to the next general area quickly? By the way, we're going to have a general Q&A at the end as well, so don't worry if we've missed your own questions. So now we've raised money, we've got an initial team in place. The next step for me as the founder and the CEO is to build this company, to build the product. So frankly, I would love to hear a lot of the panel's views on what are the practices or mistakes that you see at this stage in your young companies, where the teams that you deal with, what are the things that they've done well, not well? What is some guidance that we can provide to the audience on this kind of next critical stage in the company of getting the product or service out?
Yeah, I think I'll start. I think there's this fallacy that the best product wins, and that's not generally the case. I know, again, from personal experience, in our space, we thought that we were the absolute best company in our competitive set because we felt that we had the best product DNA and the best technology and so on, and we therefore went to customers and pitched our solution that way. And ultimately, you know, product was important, but it wasn't. And I think this is generally true in most cases in enterprise software. It's really about, you know, it's sales and marketing. It's distribution. You know, if you're not out there with the largest market share and in front of the most important companies in the space, it doesn't really matter. And so I think that, especially in the Valley, given that we have such an engineering-heavy culture here, I often will coach founders to think about, again, this idea of minimal viable product, or just enough, right, to meet the initial set of customer needs, which means that you should be talking to customers all the time about what their needs are. And then, you know, focus the rest of your time on figuring out how you can get as many possible customers as quickly as you possibly can.
Yeah, well said. I think always be talking to customers, and that's a challenge in hardware. You know, how do we constantly engage consumers at different iterations of a hardware cycle? I think one thing that one of our investors told us, speaking of staying close to investors, is, you know, meet 100 customers, know them very well, know what their home looks like. For us, know where their dog eats, know where their dog drinks. Literally walk around the home. Knowing those 100 consumers really well and having that image in the back of our head is far more important than getting interest from millions of people right now, which we couldn't even act upon. And so know early consumers very well, talk to them, have them be advocates, and learn from them throughout your product cycles, no matter what you're building.
I think those are great points, and I think Silicon Valley is very product and engineering oriented, so a lot of times, and you look at some of the great companies that we admire, they never really had a head of marketing. And so you could say to yourself, like, oh, I don't need a head of marketing. But if you don't have, you know, if you ship your product and no one's really using it, I would say that you probably want to figure out someone on the team who's in charge of getting people to use your product. I mean, like, there's a company that we're co-investors in where, in retrospect, they've done okay, but in retrospect, we haven't made some of our numbers. We actually don't have anyone who's in charge of acquisition and retention. So in retrospect, like, that's probably a mistake. I think Gentry had an awesome kind of market entry strategy. You should probably talk about it, because that probably made all of your life a lot easier because you figured out how to get, like, create some demand out of the box.
You mean the waiting list thing?
Huh?
But yeah, in our case, that was very much born. I think in general, when you're Steve Blank's, I like Steve Blank's description of a startup as this short-term business entity that's on a quest for finding product market fit, and that basically a business goes through two stages. The first is the search to find that thing, and then the second is the scaling once you found it to reach as many of your customers as possible and to lower the costs of acquiring those customers and lower the costs of delivering the product to them, et cetera. So if you divide those two things, that first half, that trying to find a product that is scalable, that there's a market for, that's really it's, in my mind, it has two pieces to it. It has that piece of really understanding this customer that you think you're going after and what their needs are, what the problem is, and building a deep, solid empathy for that problem. Often that means going after a problem that you yourself feel, because that's an easy way to build empathy, but that often means you're also in a saturated area where a bunch of other engineers sitting at computers all day are going after the same space. When you can build empathy for a different kind of person, you often can find really big opportunities. But then the other piece is really iterating like crazy, like trying to tweak a product or solution until it really hits on a match for that need as best as you can. And as you start getting towards it, I think it's Andreessen or Horowitz, one of those guys were saying that, like, once you get there, you'll know, because it'll be like the wind in your sails. It's like the boat will just start to move. And we found that with Mailbox. Mailbox itself was really an iterative attempt to fix this to-do list that we had launched that wasn't working that well, that some people were liking but very few people were staying with. And we were iterating internally and with a small set of users trying to figure out how to change it, and realized that the real opportunity was to attack the inbox directly instead. And once we started to tap into this interest, kind of, it went in a very different direction for us, and we launched a video kind of ahead of the product with an attempt to basically tell some people that this thing was going to be available and hope that they would spread it, but it kind of vastly exceeded our expectations of what we were going to see. And in our case, there was this big server-side component. So I think what Aileen is talking about is the next thing we ended up doing was building effectively a waiting list for the product that itself kind of became this weird thing, because on an app, you download this thing, and even if it's not working yet, it's still sitting on your phone. It's very intimate and strange. It needs to do something. So in our case, it just told you how many people were ahead of you in line. And when that shot up like nearly to 1 million, it caused a whole secondary effect of press, and we got all this secondary marketing benefit from it. But I think the thing that was most important was that constant iteration, that constant trying and assuming you don't really know what's going to work. It's this weird dichotomy, because to your investors and to your employees, you want to a certain extent project this air of having your shit together, pardon my French, and knowing where you're going. But the reality is, if you're not very open and very willing to iterate a lot, there's a good chance you're not going to get there. So there's this duality to it that is a challenge.
I would add, I think when you iterate, you want to iterate on things that matter. And of course, sort of in a startup, you never have enough talent, you never have enough time, you never have enough money, you never have enough data. And so that basically means, you know, you have to steal. And what I mean by that is, you know, when you think about what makes your product different, that's where you want to focus on all of your attention. And so if you're building a commerce site and a product manager comes to you and says, oh, I want to build this great checkout flow, fire them. Because the only way you need to build a checkout flow is to go to Amazon and practically pixel by pixel copy what their flow looks like. And there are a couple of benefits there. One, you know it works because Amazon does it. Two, you know your customers know how to use it because everyone uses Amazon. And three, you know that sort of, if you get that data and no one wants to buy whatever it is you're selling on your site, you're going to know that it's not because your checkout just didn't work. You're going to know it's because there's something more fundamental in your product. So steal the things that don't matter. Reg flows, checkout flows, things like that. Just totally be like, find the best in breed and just don't even think twice. Just steal, 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 and focus on the things that make you different.
Yes.
And I think you need to ask yourself all the time, are you providing a vitamin or a painkiller? It was one of the best pieces of advice, questions that I had from an investor when I went to go pitch him. And he couldn't understand what the hell I was trying to say at the time. And ultimately I realized it was, he asked me, is this a vitamin or a painkiller? And I realized that what we were doing was just trying to solve you know, a nice to have for our customers, which made it really difficult to even communicate the value of what we did. Whereas I think, you know, Gentry and Mailbox, for example, it's so easy to understand what it was, and it's such a painkiller because mail on our smartphones sucks so bad today that, you know, people have like bleeding neck wounds. All they need is something to kind of, you know, patch it up, and that's what Mailbox was. It's so easy for people to get.
That's great. Let's say I've iterated and I've tried everything under my current product or service, but everything has failed. Is it okay for me to come to you now with plan B, which is completely different? And when's the right time? Is there a right time? You know, what's the thinking around companies that find themselves in that situation?
So I think this is a really important question. There's different schools of thought on how you handle the situation. When your solution isn't working, what do you do, and how far do you pivot? There's a natural reaction, I think, among entrepreneurs to want to pivot quite far. And there are a couple of cases of success stories or somewhat success stories that work that way. I think it's really hard, though. What we tried to do with Orchestra was limit our degrees of freedom in pivoting to one. That is, if you think of, if you imagine you've got 1 foot on the problem you're trying to solve and 1 foot on the solution, like go in a circle, but keep that left leg, that first leg, like planted firmly. No matter what, I think you need to deeply understand the problem you're going to try and solve. And so much of this is about motivating a team to join you on this adventure. It can be very difficult if you're sort of willy-nilly going after different problems and different audiences and different areas at the same time that you're exploring different solutions. I come from a human-centered design background, so stuff that is out of the IDEO school of thought, David Kelly, the Stanford D School, this sort of thing. And this human-centered design starts with a deep understanding, that empathy of a problem, and then just iterates like crazy on the solution, but it never lets go of that problem. And the solutions that don't work can even teach you something about the problem as you understand it that helps you with the next one. I think personally that that's enough, that you should probably start with something that you feel passionately about, because you're going to give a lot of your life and time to it, and then don't give up until you solve it, and try like crazy around the solutions, but never let go of the underlying problem that you're trying to fix. But that's a human-centered design perspective. Like the lean startup stuff takes a very different approach, and maybe someone else can speak to that.
So I'd say I think the big pivot is a little bit of a myth. Like, it's not so usual that you had a big idea that you spent a bunch of time and you recruited a team and you all worked on, and then you completely shift gears into something else. But I think there are some good examples where there have been big pivots. So obviously I think it's okay, and a lot of it is, people have talked about this before, the relationship that you have with your co-founders and your team and how well you guys are getting along when things aren't working is kind of going to help determine also like whether you guys all decide to sign up to try and do something else together. And also with your investors, I think the level of transparency and collaboration you have about like, okay, here's how much runway we have, here's what our burn rate is, we're going to spend 9 months doing this, and that'll give, if it doesn't work after 9 months, we still have another 9 months to figure out a plan B. Like you don't want to surprise your investors and call them a month before you run out of money and be like, oh, sorry, like we forgot to call you.
You really don't want to do that.
Right, exactly. But I mean, some of the investors that both entrepreneurs and investors that I admire a lot are, the Twitter guys, right? They actually started working together on something called Odeo, which was a podcasting platform. And I assume, I wasn't one of them, unfortunately, but that they had a good relationship with their...
We can make it more unfortunate. First round was an investor in Odeo, but not Twitter.
But like some investors had a good relationship with the founders, and the founders said, we have this other idea, and some of the investors stuck with them, and it became Twitter. Same thing with
lesson learned.
Same thing with Instagram. So Instagram started out as a mobile app called Bourbon, and it didn't work. And they went and had a conversation with their investors, and I don't know if all of them or how many of them stuck with it, but it turned into Instagram. So it can happen, but you have to kind of give yourself the time and the...
But Bourbon's actually a really good example of the limited pivot as well, because Bourbon did a number of things, but Kevin saw that one of the things that people were struggling and bending over backwards to do was share photos through the Bourbon app. And while it did a whole bunch of things that had social check-in and some mafia war stuff and personal expression as well, he ended up just removing 80–90% of what the app did to kind of focus it down.
The untold story on Instagram is actually how Kevin from day one set up. I mean, he was building an HTML5 app back, it was about 4 years ago, 5 years ago, when no one thought it could be done. And his sole reason for doing it, he knew performance stunk, but he did it because he said, I can iterate quickly and it's too hard to iterate in an app store. And I think that's sort of like a great example of that product was set up from day one to basically sort of be a learning product. But I'd say just on some of these things, though, your employees will know when a product or the business isn't working. Your investor, you certainly know. Your investors may or may not know, but the good news is your investors kind of, statistically, we don't expect it to work out. So
I don't think I would not say that.
Denial. But the point there is sort of, the door is more open to have that conversation. Your investors will understand and want to help you and want to problem solve with you. Like, and I just think sort of embrace that, sort of lean into it, and don't try to do it. Aliens do it now and deny it.
I think like your time, and of course your investors' time and money, is so expensive, and there's such a high opportunity cost that we often forget. I think it's such a great example that maybe Instagram and Twitter may not have been, may not have been achieved if founders didn't continue to stick with this general idea that they had, or the team. But I would say 99.999% of the time, you can think about it the other way, where if you don't stop working on what you're working on today, you may not be able to create the next Twitter or Instagram. And so, in that sense of being self-aware, there is a point where you have to kind of step back and say, this is not working. And it sounds like it happened in both of these cases, whether they're big pivots or small pivots, whatever it might be. Your time is so valuable. Why continue to spend time and money and effort and so on working on something that isn't going anywhere? Sometimes it's just better to like stop, regroup, and set course on a different problem.
Great. So questions around product and yes.
How large is the team in terms of this client development, iterative phase, and overall, what did you view as the burn in terms of dollar cost and time associated with it?
So the size of the team really depends on the space in which you're trying to iterate. Single player tools, that is a tool that a person uses on their own. You can prototype pretty easily. You can prototype them often without even necessarily coding. You can do a lot of paper-based, or you can do screencasting onto a phone if you're doing a mobile app while you're actually powering it through something on a computer. There's lots of quick, rough, and easy ways to prototype stuff. HTML5 is great. There's increasingly a lot of JavaScript-based ways to build feels like, works like interactions without having to get in and actually build in Objective-C or in Java if you're building for Android. When you get into apps or software that's social, as increasingly so much of the stuff that's kind of taking the market is, that's actually a lot more difficult to prototype, because you not only have to have the interfaces figured out, but you actually have to be facilitating human-to-human interaction through them. And there's only so much of that you can fake. Really, when the learning begins when real people use the stuff together. So in Kevin's case, the learning begins when people are actually sharing photos with one another through your game app or whatever. So that significantly increases the cost, because it means you need a real app. You need it on multiple devices. You need some server backend that allows those things to talk to one another. If you're doing hardware, it's a whole nother game that I personally know nothing about, and okay with that. But so there's no one right answer. I think in general you want to keep the team as lean as possible and optimize for the agility of giving yourself as many cycles in a given amount of runway as you can. But it's one of these optimizing functions where if you don't have enough people, then the ones that are there are going to effectively be sitting on their hands. You want to get enough folks that you can basically iterate quickly. I don't know if there's one specific. In our case, we had several people working on a back-end server system that was a node-based thing, put a strong emphasis on real-time communication and keeping stuff happening fast. We had a couple guys running on the front end. We had a couple guys, men and women, doing front-end design. And at the time that we really made the pivot from Orchestra to Mailbox, we were, I think, 12 or 13 people. But that's a little on the bigger side. Yeah. It turns out that actually trying to make a dent in something like Mail is fairly heavy from a technical perspective. It's pretty complicated. Other prototypes would require much smaller teams, 4 or 5, 3 people. Talk about it.
Yeah, hardware is totally different, for better or worse. There are, I think that's a great summary though, overall, and just the goals you should try to achieve. So have the leanest team you can, and learn as much as you can in each cycle. In hardware, there are a lot of new tools that allow you to do that kind of thing in prototyping, things like 3D printing. There's Arduino, there's just different types of hardware now you can hack together. In our case, very tactically, we had big, hunky blue data loggers that we didn't build. We bought them from this company called Gulf Coast Data Loggers in the East Coast that uses this for a totally different use case. And they're big, and we'd put them on dogs, and then we'd show the data, not in real time, but a week later to the owners. And we would just basically say, is there a there there? Our owners were reacting to this data at all, it's their dog. And that's when we were able to say, okay, owners are super excited by the data, here's what they want. That was actually in the discovery phase, we realized they wanted to do remote monitoring. We were going to build a Bluetooth device at first. Turns out a huge core use case for us, speaking of kind of pivoting with one leg on, was remote monitoring, not just health. And so we had a Wi-Fi device. So there's learning you can do in hardware. Very tactically for us, our team at that point was actually sub 10, but then as soon as we wanted to build anything real and have an app team as well as a hardware team, we're now 18 full-time. And I think at the iterative stages can probably hold about a dozen, but that's really hard in hardware if you're trying to manufacture product.
Okay, great. Why don't we jump to the next topic quickly, which is, I think that the question from before, and that is, throughout this process, I am in communication with you, the investors on the board, with my other team members on the board. Obviously, there are some clear guidelines. Communication we've talked about already, no surprises. But are there other practices that the panel can share with respect to the board of directors that will be helpful to people hearing now before they get engaged in that process?
Yeah, I think one good practice is share a live dashboard with your investors. That way, sort of when you meet with them, you don't have to copy a bunch of pictures, put them into slides, and then waste the time you have with investors trying to explain what each graph means. And that there's no brain damage than the brain damage you get of sort of going through a bunch of charts on a board right now.
Yeah, completely. And I would say along those lines, always meet your number. Always. I think that 99% of the problems that you have with investors can be solved if you're meeting your number.
I would say.
It's that easy.
Yeah.
It is. It really, really is.
I would say it's okay to not meet your numbers. I think, but what's important is to have a thesis as to why.
You better have a damn good thesis why you missed your number if you missed your number.
Since it is a panel of mistakes, certainly a mistake I made early on in the company history is treating board meetings as operational updates. And this might be what Kent's saying as well. I mean, even if you have a really supportive and engaged board and board observers, walking through, especially with your broader team, for more than an hour, just what's going on with the business is a waste of time. And that's not because your investors might not enjoy it, but you're not leveraging their time to get real strategic advice on the core issues facing the business. Yeah. So whether it's having a live dashboard or just generally structuring your board deck to say, these are the 5 key things I want to make sure I get your input on. Don't just say, here's an update on hardware and firmware and software. It's not a good use of your time.
Yeah.
So I echo all that. I think it's good to create a rhythm where, like, here's what the board package is going to look like every time, right? And that way you don't have to create new slides every time you have a board meeting, and pre-send it more than 24 hours in advance so people have a chance to read it. And they basically get, like, you should expect that your board members or your advisors, whoever, do study hall the night before and they've read this stuff. So you use a half an hour to actually answer any questions they might have about, like, the reporting stuff, and then use the time when you actually have live people in the room to have a conversation about something you're stuck on, or a strategic fork in the road, or something that you can't figure out. And then I also would ask your investors, whether they're on your board or not, to help you. Like, I think that, squeaky wheels get the oil. Like, give people homework assignments. Like, here are 5 customers that I'd love introductions to, or I need to hire a head of marketing. I've never hired one before. Who has experience hiring one, and who will be who will partner with me to interview my final 3 candidates? Like, it's not. It shouldn't be a one-way conversation where you talk at them for 2 hours and then they leave. It should be it's a dialogue.
Give homework assignments and keep grades. and
get them to compete with each other.
And make them public. Yeah.
Play them off each other. Kent, you really helped me after the last meeting. Gentry,
I did.
Where are you, buddy?
Great. Questions around board practices? Yes, right here.
When is the best time to create a board?
The company has a board from day one. So do you mean adding independent directors and so forth? So typically, the panel should speak to this, but typically you wouldn't have any non-founders on the board until you started to raise money. But
yeah, I was going to say, I think you can. I've seen one founder that I'm very close to who decided to really, in his operating plan, he wouldn't be raising institutional money for quite a long time. And so to take advantage of some of the benefits we spoke to earlier around having that infrastructure in place, he just created an advisory board that he actually treats like a board from the beginning. So when he launched the company, he put, there was maybe 3-4 of us, and he kind of instilled that rhythm, sent us the board package, so on, and so asked us, gave us our homework assignments, checked up on us, has that email that goes out every month that rates us on who did what they said they were going to do and who didn't, and really got that started. And I think he just raised around about a month and a half ago, and because he had that, again, raise the institutional rounds, it made sense to bring one of the lead VC on the board as the representative of preferred. He already had all that cadence and that infrastructure in place already, and he's just going. He doesn't have to waste any time on building it from scratch.
I think that's the right way to think about your board. Even as a C-stage investor, I've stopped thinking about board seats, and I actually now have this new goal in life, which is to never serve on an audit committee or comp committee. So I think what you want to do is find people who can give you good advice, figure out who you want in that room, and treat them as your board, whether or not it's officially documented as people having board seats or not. And they'll sort of engage with you on the level that you engage with them.
Yeah, it really goes back to what we were talking about earlier about looking at co-founders and investors as partners in this quest you're on to build a sustainable business. If you've done that work ahead of time, if you've brought in people that you trust, that you enjoy working with, whose opinions you respect, that have expertise that you don't have, then board meetings are less around formalities of covering your ass, and really they're just dedicated times to get strategic together and bring really smart people who you value into a room together and really push on the deepest challenges that you're facing as a business. So I think if you set all those pieces up right, this solves itself in the sense that these become the times where you guys get together and really push on the hard questions.
The legal, and I'm saying this sort of in a room full of lawyers, so I'm going out on a limb here, but the legal rationale for having a board is for governance, and most early stage companies don't need governance. What they need is strategic discussion.
Right. Did either of you take an independent board member?
We did, yes. Yeah. And it was a great decision for us.
Who was it? I'm curious. It's something we've thought about.
Yeah, so we were an enterprise software company whose sort of destiny lay in being a part of that ecosystem. So we took the chairman of a company called Endeca, which was one of the larger enterprise software companies that had a sort of marketing angle to it, the way that Involver did. And it ended up being that the independent board member not only was he in the space, had relevancy at that point in time, but he was also an operator over 15 or 20 years. And I felt like, again, this is, as the founder, my perspective was, you can kind of have an independent board member who has a really great profile, but may skew a little bit more to your preferred, or you can have someone who's maybe not as high profile, but he's kind of your guy, and he's kind of, you can go to him before you go to your preferred for advice and so on. I actually found that this person was able to do both for me all the time. And I guess the one thing this does bring up, which could be a little bit controversial, is that I think in the end of the day, this notion of awareness, right? I think in the end of the day, you have a job. In the end of the day, you have a job to do. One of your ultimate responsibilities is to make sure that you go home, and if you have a family, you put food on the table, you take care of your family, and you're kind of building that equity for yourself, right? And your legacy and your career. And in the same way, I think your investors who are sitting on the table with you have the same objectives. They're working professionals. They have a career. They work in a job where their career progression and their sort of their equity and wellness and net worth and so on depends on this investment producing results for them. And I think there is that kind of that fundamental reality that, as much as we talked about earlier, that find someone who empathizes with you, find somebody who shares the same values as you, that you have chemistry with, and so on. And I think that this happens a lot more on the seed side. It's much easier for us to deal with on the seed side. I think fundamentally you do have to remember that your investors are not your best friends in the end of the day. In the same way that you're not your investor's best friend. Like, you have a job to do. Ultimately, you have you have a sort of a selfish objective, and in the same way, your investors do. And that's not a bad thing. I think that's just the reality, and you should be aware of it. So in the case of, I'll give you an example. In the case of surprising your investors, you don't want to surprise your investors. They have to go, to their partner meeting on Mondays, and all of a sudden they have to say that this company that was doing really well may not be doing so well, or that this company that it was about to raise a round now all of a sudden needs a bridge, and we need to pony that money up. You don't want to put your investor in that situation. That's not good for them in their career.
Okay, yes, please.
Can you talk quickly about geography in terms of business partners as well as advisors, how important it is to have them sort of in the same geographic vicinity? Or have you had people, do you do a monthly conference call if you have advisors all across the country, if not the world?
I'm a huge believer your core team should be in the room, probably sub 50 employees, but certainly sub 20. That's your full-time employees. Now, if you have advisors or investors across the country, I'm sure they could add a lot of value, and then just try to have regular calls with them. But I really, really believe that your team should be together wherever you are, and that's not just founders, the core initial team.
Yeah, I think as an investor, geography actually doesn't matter as much as you think. First round, we're a national firm with offices on both coasts. So if I meet a really interesting company that happens to be on the East Coast, I'll probably try to connect them with one of my partners out there, because I do think proximity helps, but it's not a blocker. And when you're talking about sort of being within the U.S. or U.S., Canada, 3-hour time differences coast to coast, it's not that bad, and I think it can be managed pretty well with phone calls, Skypes, and sort of I'd say, explicitly plan face-to-face interactions on a regular cadence. But overseas, it's just a mess.
I would agree. I think if from an investor perspective, if you're a seed stage company and you're pulling together a couple different investors to be in around, it'd be good if there was at least one anchor investor that was local. But I also, and if you're going to have out-of-town investors, I think they should be ones who basically on a regular basis do get to see you face-to-face. Either if you're in New York, you come to California for work, every month, or your investors come to see you. So because it's a personal business, right? Like these are personal relationships, and it's about being able to sit down eye to eye and talk through stuff. So I think that has to happen, or at least that would be preferable.
Let's cover the last topic quickly. I think we're running short on time, which is we finally did it. We're out there. We have more than 5 million users, and it's potentially time to start thinking about liquidity. We've got a number of people on this panel who have gone through that process. What are the things that I should be thinking about? What mistakes have I made or will I make now that may affect me as I get to that point of wanting to sell the company to an interested buyer? Is there anything that we can share right now about that, about doing something now that would be helpful?
It's a good, like you've probably heard this many times before, but a good company is bought, not sold. It's told to me so many times in the last 3 or 4 years. I think the way that the company is bought is by you focusing on building your business and building a great brand and building revenue and building traction and doing all the right things to make sure that your company can stand on its own 2 feet, and you don't need an acquisition or you don't need, let's say, another expensive round of funding or whatever it might be, and then it'll happen. I know in our case, just by virtue of just focusing on building the business, we slowly had companies like Oracle and its competitors come and talk to us and just ask us what we were doing in our business. And we have, here was a really good one. One of the ways I think that drove all of this was having an overlap in customers. So I realize this now being at Oracle, that we have a lot of people always coming up and talking to me or talking to my team about acquisitions in the social space, for example. But fundamentally, the only way we'll prioritize any of these conversations, let alone actually going through with something, is seeing if there's an overlap in customers. Like, do our biggest customers care about this? And when we find out in meetings that a customer will say, oh, have you heard of this technology? We just bought it, and we're trying to figure out how to integrate with your application. How does that work? And you hear that a couple times, 2, 3, 4 times from big customers, and all of a sudden, okay, we're picking up the phone and calling one of these founders up. And I think that's a great way of having the company bought, not sold.
I would just say you can always, when companies are bought, chances are they'll be bought, there's a chance for them to be bought again at some future point at a higher price. So actually, I always think it's worthwhile, as founders, you should have open discussions with your investors about some measures of founder liquidity along the way. I think sort of more and more investors are comfortable with that, especially if it gives you the financial cushion or the financial diversification that you need to really think about sort of going long and building a big business. The only thing that I've ever seen sort of offensive done around that was I did have one founder say to me, I want to sell as part of this round because I need the cash. I'm like, okay, totally get it. You built a great business so far. Take care of your family. Take care of college education. But then the next sentence was, and I also want to be re-upped, and sort of have that equity sort of given back. And that just didn't sit well.
The other thing I'd add is if you are in the process of evaluating offers or people are making inquiries, this is also where counsel can be a really good advisor to you, because this is where your investors, or even you may be more of a product person or an engineering leader, or your investors may be more like company builders, and there's a certain kind of corp dev skill set about, it's almost like, the dating book, like the rules, right? Like there's like a dance that you have with potential acquirers, right? And it's not out of the blue. Like someone walks up to you and decides to buy you, and then it happens 2 months, like a month later, right? It's like you've kind of been dancing and flirting and talking over the course of a year or two. And counsel or other folks who have more kind of corp dev M&A experience can be good, helpful outside advisors to kind of coach you through the dance.
One of the things that actually we took from Orrick really early was you'd say yes to every meeting with corp dev and big companies. Not even if you, doesn't matter if you're currently thinking about acquisition or not. To Aileen's point, if that does happen, it will be the result of a much longer relationship. And so think of it as laying down seeds and meeting people and beginning to build relationships. And maybe one of them at some point will come to fruition and play out in that way. But if it does, it will probably be because it's been building over a period of time.
Questions? Yes.
So initially, when you raise capital, entrepreneurs we have like, okay, plan A, I want to raise this much. I can build this much out of it. Plan B, this maybe larger amount. The question is two-part. How does that affect later in the liquidation stage? What do I need to decide now? I don't want to raise too much that's going to affect me later, or I don't want to raise too low that. So how do you make that decision and have that conversation with the investor? Is it less, is it more?
I think the question is around how much to raise and what effects to avoid the consequences of dilution down the road in connection with an acquisition and so forth. Any thoughts around amount of raise in financing? So how do you go through that?
I just think sort of hearing you sort of describe that, it sounds like you're worried about over-optimizing. You raise capital for the purposes of the business. And so I think a great rule of thumb is target about 18 months of capital and know exactly what you want to do. And that will change sort of based on sort of exactly what milestones the business might hit along the way. You might say, oh, I actually need closer to 20 months or whatever. But the reason I think 18 months is good is you have to assume that your next round of capital will probably take about 6 months, or actually, it'll take 3 to 4 months to raise, but that everything you thought would be done after 12 months will actually be done after 14 months, so you want to build in this budget. So 18 months is a good rule of thumb, and don't worry about over-optimizing. If you can get more capital early on, take it.
Yeah.
Okay. Yes?
When do you know it's time to sell? Few years, few months, when?
When's the time to sell?
It's a tough question. So I think there's different moments in the cycle of a business where you can sell it and you're selling different things. So a lot of the acquisitions we're seeing are basically being referred to as acqui-hires. It's really about a team that's been brought together that's proven some capacity for working or has amassed some talent, and that talent itself is attractive. And so maybe hasn't been any sort of product market fit yet, but that team itself is valuable to some other acquirer, and so there's a moment that you can take advantage of there. If you manage to get a product that does have product market fit, and there's a company that wants to be in that space, then you have not only a team, but you have a product or a set of customers that you can also sell. Maybe further on, you've got actually a working business that's generating revenue and is itself in the black and growing, and that may be something that can be magnified or multiplied by the right acquirer, and so there's another moment that you can take advantage of there. I think thinking about where you are in that state, in that process, and what it is you're selling is really important. But then there's also these macro level forces. To go back to this point about selling a company, a good company being bought and not sold, there will be moments, I think, in each of those different inflection points in a company's history where there will be a lot of interest. And it may not only be from acquirers, but also from investors, and there may be a mix of those things happening at the same time. And those moments, they have their own sort of energy where you effectively can use all of that interest at the same time to create some sort of exit event. And there's a sense in which you eat when dinner's served in that sense, and you need to pay attention to what's happening to your company and respond to it, more than driving through with an agenda you decided upon at some earlier state. Does that make sense?
Yeah, it makes total sense. I think there's it's a really hard question to answer, but I do think being self-aware about, to as much as possible, the realities of where you are. I do think that sometimes everybody we all kind of love startups because we're optimists, right? And so there is often a tendency to over-optimize and maybe also not realize that you could be at a local maxima when you are. I think that there are probably companies that most of us think, you know, they have had the opportunity to be bought for $1 billion, for example, but the founders are like, oh my God, we're going to be worth $5 billion, and so they'll turn down the acquisition. But it turns out that in retrospect, that was a local maxima. Like $1 billion outcome would have been an awesome outcome, and you know, and so just kind of, if you can, try and have the perspective of where you are, and you know, looking back 5 years, if you'll feel like you made the right call or not.
Yeah, and I just think there's so many different perspectives on this question because it's so deeply personal, as you're hearing from the panel. One slightly different one is that, like it is actually this point of self-awareness. Like, what kind of business do you really want to build here, right? And I think this is sort of a crude way of thinking about it, but it's like if you want to build a small business, the best time to sell it is before you're generating revenue, in my perspective. So you know, you're sort of selling on like the promise of what this can deliver. Then I think if you know, after that threshold, then you start being measured by like, let's say, a revenue multiple or something. So when you get sort of a little bit larger, then it's more about sort of those financial metrics. And I think you know, conversely, if you say you want to build a really big business, then you should build it, you know, build it for as long as you can possibly build it until you know, one of these alternatives presents themselves, or you kind of you look in the mirror, and this has sort of happened to me at the end of my run after five and a half years. I was really tired. I was so exhausted, partly because I made so many mistakes in how I ran the business that I just had no gas in the tank anymore. I was just hating to get up in the morning, like for the last little while. Like I was just so burned out. I never took a vacation. I had so many failed relationships. It was terrible. And like the 2 years in Palo Alto where I hadn't gone on a date in 2 years, like that sort of didn't help. So I think there's also a very personal question: how much gas do you have in the tank, and can you really continue to be the absolute best person to continue to lead this company in the months coming, years coming?
You know, remember, the assumption is that everyone wants to sell, but obviously your investors have typically protected provisions where they have to consent, and they will invest it at a much higher valuation than maybe, you know, or at a high valuation. Their exit point may be much, much higher than yours is. So there's going to need to be a deal that everyone is interested in doing. Let's just take one last question and then we can close it up. Yes, in the back.
Hi there, Aileen. You mentioned about wanting to see traction for a lot of these companies before putting in the seed round. Can you talk about some of the specific traction milestones that you chose for the companies you actually invested in, as well as for yourself?
Yeah. So I would say it's not an absolute rule, but I would say in today's world of, you know, AWS and open source and other things, you know, I kind of feel like, you know, especially if you are an engineer, right? Or if you're, you know, if you're not an engineer and you're going to be building a software company, you really have to find a technical co-founder, right? And then if you're a technical co-founder and you can, like, wireframe out some stuff, or, you know, build a little bit of an MVP on nights and weekends, and just even for yourselves, just to prove to yourself that it's a good idea and there's a there so that you can quit your job, or, you know, tell your spouse, like, I'm going to take this huge risk and in doing this. Like, I think a lot of it, so it's, I don't really have specific, like, oh, you need 100,000 monthly uniques or anything like that, and it's nothing that grand, but I think it is some proof points to show that, you know, whatever the market risk is, if it's a super technical risk, that's hard to move on very little resources. But if it's a lot of both enterprise and consumer companies are, there's a lot of market risk, right, and like adoption risk. So what can you figure out that will give you and the people that you're going to recruit to the team and your investors a feeling like this is not an insurmountable risk? I'm sorry if it's like kind of a vague answer.
Some of it is, I think it's important to be creative about what engagement looks like. Not all engagement is a user growth curve, which is up and to the right. It might be that you have a relatively small number of users, but what you can see is they go from, you know, doing whatever they need to do with your product once a week to, you know, twice a week to, you know, 3 times a day. And even on a small user set, that's really powerful because it's a very strong signal that you built something of value.
Absolutely. So here's another specific example. So there's a mobile app company that we have been talking to where they built a very lightweight, it's not pretty, mobile app, and they found 50 people to use it. And they've been tracking the behavior of the users over the past 8 weeks. And even though it's only 50 people, they are gaining insight into, like, you know, we lost 20% of them right away, but the 80% that we've kept, they've gotten more and more engaged over time, and then we actually sent them an email saying, hey, we're gonna move to premium service, and it's gonna be $20 a month or something like that, and a third of the people opted in to pay. It's only 15 people, but still, it's kind of, I think they're showing tremendous scrappiness because they just did that all on their own.
Great. Okay. I think we're basically at our time. So let's thank the panel here today. Thank you, guys. Any last thoughts from anyone? Or
I actually think Rahim said the most important thing. Take vacations, take weekends.
Go on a date.
It's a marathon, not a sprint. So set yourself up for long-term happiness, and your brain will work so much better.
Thank you, everyone.